I want to thank Tom and Stan for having me down today, and I really appreciate all of you coming out to listen to my presentation. I've got a handful of slides to go through. I'm going to talk a little bit about the relationship between the economy and markets, put the recent volatility in context, recent volatility that we've had in context, and then also talk about some of the opportunities and risks that we're currently facing. So, now bear with me. The slides are a little slow to move here. Oh boy. Sorry, Stan.
No problem.
All right, here we go.
Please make sure you read all that.
Yeah, it's important disclosures.
Oh, and just in case you're wondering what we're going to do with the pictures that we took, we're going to be selling those to Facebook later. So.
All right, so let me just take you through the first slide. Well, what that's showing you is all of the recessions and bear markets since World War II. And so what's interesting about this chart is it shows that out of all the bear markets we've had, every single one of them has been accompanied by a recession, except for two. There's the Cuban Missile Crisis and Black Monday in 1987. And so those last two cases, the recovery in the market was very quick, between 3 months and 6 months, whereas the average time for the market to recover from all of those other recessions was anywhere from 12 months to 31 months. So it's very important as an equity investor to be watching what's happening in the economy. If we're going to be heading into a recession, that's the reason why you should start to change your allocations. But unless we're heading into a recession, it makes sense to stick with your allocation, and we saw that at the end of last year. So this next chart will take you through a little bit closer up view of what I was just talking about. So over the last 4 decades, you can see the annual returns. And if you look at all the bars, it'll show you annual returns for each year, most of them higher, which are the positive returns. But if you look at all the bars at the bottom, the times that we've had downturns, almost every single one of them, again, accompanies a recession. So that's 1981, 1990, 2000 to 2002, 2008. And really, if you look at the annual returns of the market, you can see those red dots below it. And what those red dots are showing you is just in the middle of the year how much the market has dropped. And so you can see almost every year we're having a correction and you're seeing a pullback in the market. But unless we end up with a recession during that year, the market will almost always get back to positive or close to positive. Now, interestingly, last year was really the exception to the rule where it's the first time in a long time that we've actually finished down more than 5%, despite the fact that we weren't in a recession. And I think that really goes to show how severe those growth fears were. So where did that put us as far as at the end of last year? So looking at valuations, if you look at the far right corner, you can see we ended up with around a price to earnings ratio about 14.4, which for the long-term average, it's been a little bit above 16. So that big pullback really created an opportunity. You can see the market was pretty undervalued based on what we're seeing historically, and really is one of the metrics you can use to see whether or not the market is undervalued or overvalued. But that's really what created the opportunity that I think we saw at the end of last year. And it wasn't just the US that was undervalued. If you look at the slide on the right, or the right half of the slide, you can see that across the board, whether it was the United States, Europe, Japan, or emerging markets, all of them were undervalued. You can look at the diamond, which is showing their actual price to earnings ratio or price to book ratio on the right, versus that purple bar in the middle. And so again, that's created an opportunity where all of those regions are undervalued based on where they've been historically. So looking at all those opportunities, I'd say, back at the end of last year, probably the United States offered the best opportunity because our economy was the strongest versus all those other economies. But emerging markets is also worth a look as well, because despite the fact that China is under some pressure, the growth prospects look really good there. And so if you're willing to put a little bit of money into emerging markets, it's higher volatility. You're going to have a little bit more of a bigger ride, or a more difficult ride, but there is opportunity to have higher growth potential. Whereas if you're looking in Europe, there's some structural problems. It's not just Brexit. You're also seeing Germany slow down, and you're seeing some of the other economies running into a little bit of trouble. And the next slide will show you more of an economic view of the world. And so all you really need to know is the green is expansion, the red is contraction, and yellow is in between. So that bottom third of the page is showing you emerging markets economies, whereas the top portion of the chart are showing you most of the developed world, with the US towards the top there, basically the fourth line down. And so if you can see in the upper right, you can see the economic strength of the United States, whereas the rest of the world is still slowing, but they're not seeing contraction anywhere. So based on an economic point of view, we still may have a ways to go in the cycle, and it's much too early to get really pessimistic, which is, I think, what a lot of people did last fall and really jumped the gun. Oops, we lost something here. So the last slide is going to show you the relationship between recoveries, which are, so you're going to see all of the recoveries post-recession since World War II. And you're going to see along the x-axis on the bottom, you're going to see the length of time that the recoveries have run for. And then if you look on the y-axis on the left, going top to bottom, you can see how strong those recoveries have been. And so the question I often get a lot is, this recovery has been running for so long, aren't we due for a recession sometime soon? And I get that question a lot. And if you look at the amount of time that this recovery has been going for, it is the second longest. If you look at that light blue line at the bottom, that's the recovery we're currently in. It's the second longest recovery since the end of World War II. If things continue the way they're going, which I think they will, later this year it'll become the longest running recovery. But what I'll say to a lot of people who will ask, just because it's been running for a long period of time, does that mean that a recession is right around the corner? And I think historically, yes, recoveries typically don't last as long as this one, but typically recoveries are a lot stronger. So if you look at the strength of this recovery versus all the rest of the recoveries, we still would have a really long way to go, even to get to the second weakest recovery. And as we go on in time, it looks like we're not anywhere near overheating. So for those people who are worried about the length of the expansion, I would also push back and say, well, look at the strength of the expansion, and that's another reason to stay positive. So the point of showing all of these slides is really to talk about valuations are still relatively attractive. The economies are doing well around the world, better in developed markets than in emerging markets, but there's a lot of opportunity out there to stay the course and to stick with this expansion and stick with your equity investments until we hit the next recession, which for now looks to be a ways out. Again, looking at the various economic data and indicators that typically will lead recessions. So I promised I would make it brief, and Stan, I think I've done that.
Yeah, absolutely.
Despite being a little...
Yeah, and we definitely want to take questions from the floor, but let me start off by just saying, I mean, obviously, you can't turn on a television or open a newspaper without reading about China and negotiations with China, and they're improving, they're not improving. I know there's some people in this room, Laura Johnson for one, that deals a lot over in those markets in China, and I don't know how impacted your business has been by these negotiations, but can you kind of put that in perspective in terms of our dependency on China as a country? And the media is constantly whipping that up. And are they making more of it than they should be? Or, I mean, how significant is that?
So China's really interesting because it's the second largest economy in the world behind the United States. And so for that reason, it definitely has a lot of importance. It holds a lot of importance to what's happening around the world. As far as the U.S.'s dependence on China, we don't import nearly as much from China as we do from other parts of the world. And likewise, we don't export as much to China as we do. So China's not as important a trading partner for us as it is for Germany and for Japan. So to the extent that China is going through some pain, we've been able to avoid some of that follow-on effect. But ultimately, if China does go down, it will take the rest of the world with it, and I think those indirect impacts will definitely hurt us. So it's important, but not necessarily as important as it is to Japan or Germany which if you look at those economic indicators have been struggling lately, specifically because of the trade war with China and the fact that their economy is slowing.
So are they going to reach a trade accord?
So, I was pretty optimistic they were going to reach a trade accord, but as I was listening to U.S. Trade Representative Lighthizer speak just on Capitol Hill yesterday, I believe it was, he started laying out a lot of the things they're looking for, and it looks like for now they are going to be pushing for a more substantive agreement, which I think in the long run is a good thing. If we can get some of those intellectual property protections and get some of those structural changes out of the Chinese, that will help business for years to come, but it also makes a short-term agreement a little bit more difficult. So I think ultimately we will get to an agreement, but I think it's going to take longer than people think.
Okay. What about another focal point is the Federal Reserve and interest rates? What are your thoughts there?
So you could argue that the reason we started to have problems last year was because the Federal Reserve continued to raise rates into what was a slow patch for us. I think they've learned their lesson. They clearly saw what happened when the market went down almost 20%. I think December 24th was the low point. And so they've completely backpedaled. They put themselves on the sidelines. I think Chairman Powell was tripping over himself to keep saying how patient they're going to be and how they're going to wait and see how things unfold. And so for now, I'd say the Fed is completely out of the ballgame, at least for 6 months, if not for longer. So from an equities point of view, it's actually a good thing. It'll keep rates lower for longer.
What about potential dark clouds other than what we've talked about that might cause some, like we had the midterm elections last year. Is there anything like that coming up that could cause some instability?
I think, fights over the federal debt limit are always kind of sneak up on people, and that'll happen later this year. Clearly, as we're heading into an election year in 2020, this year is going to be a setup for a lot of political infighting. So I think as far as, known unknowns, those are in that category, but I think it's always those black swans that hit us where you just don't know where it comes from, and that's why it's important to get the rest of the world moving again. If everyone's economy is strong to start with, it can absorb shocks a lot more than if you're not. So I would guess it'll be something political or something out of left field, something like that.
Questions?
Well, the national debt, of course, continue to balloon and whatnot. What impact do you see that having on the economy?
I mean, over the long term, it's going to have a huge impact, I would expect. In the short run, we've been able to go a lot longer than people expected, having a huge debt, and part of that is because interest rates have been so low. I mean, ultimately, when our debt payments start to become such a huge portion of the federal budget, that's when we potentially run into problems. But for now, interest rates are low. As a percentage of our GDP, the debt service is still pretty manageable, and the fact that we can pay back those debts in our own currency is a huge advantage. And I don't know if anyone's been following the news, but they're talking about this MMT theory, which is this new economic theory that deficits don't matter as long as you can print in your own currency. And I think that's ridiculous. I mean, they always matter. It's just a question of when. But I think there's no doubt that being able to service the debt in your own currency can definitely help you to go for longer. And if you look at the Japanese, I mean, they've been doing this for 20 years at least, and their debt to GDP ratio, I want to say, is like 200%. So they're in a much worse situation than we are, and still they haven't hit a crisis, but at some point it's absolutely going to matter. Yeah, I would think so. Yeah, good question. Did you have a question?
I'm just curious, you talk about the velocity of the current recovery compared to historic. Everybody likes to look back at World War II.
Yeah.
Isn't it just a new norm? Isn't there some case to be made that this is the new norm? Both, maybe they're not exactly causal, but the new norm is the velocity of recovery and prices. So you mentioned that you're still trading at discounts.
Mm-hmm.
Maybe that is that the new norm? And we have to change our mindset because of the speed with which things happen in this market versus 1937, 1952.
Sure. I mean, I think if anything, what happened in the Great Depression and in the 1920s, early 1930s, that had a psychological impact on investors for decades to come, and that's probably more of a parallel to what we're seeing right now in terms of the financial crisis we saw in 2008 was unlike a lot of the other recessions that we'd had prior to that. It was a financial crisis. It was a panic more than a garden variety business cycle recession, and for that reason, the recovery is going to be a little bit different. But I don't think it's the new normal necessarily that we have to have a lower valuation, but it will be that case as long as there's not confidence in what's happening. So the longer we can go without having a recession, I think the more likely we are to get confidence back, and you'll see valuations go higher. And we were above 16 just last year. We were probably in the 17 range, but it didn't stay. That's true. That's true. Sure.
One big difference, too, is that the availability of information on what's going on is
From my point, the speed with which behavior occurs now is wildly different than what happened in all the previous recessions. You could argue maybe not in any one. So now, why wouldn't behavior? I just don't understand why there wouldn't be an acceptance of a number of years of performance at this current velocity, and let's just live in a world where prices are what they are, rather than an expectation of historical norm outside of date.
I mean, I think the information that we have available to us today, we've probably had since the 1990s, right? So I think you can go back maybe 20 years at least, and I don't think things are radically different today than they were 20 years ago. They're definitely different today than they were 50, 60, 80 years ago. But I think ultimately, what hasn't changed, regardless of if you look at technology or the speed of information, business is still business. You still need revenues. You still need profits after expenses. I think debt still matters. Velocity of money still matters. The really large things that move economies, which are probably debt cycles and profitability cycles and business cycles, that hasn't changed. And as much as the Federal Reserve probably wants to inject itself into that cycle, they've been doing that for 100 years, including since the Great Depression. So I think the really big factors are still there. But you're absolutely right. The speed at which prices change is, stocks going down 20% in a day, that's a little bit more unusual. That's the new normal. But ultimately, I have to believe that investors are going to still value businesses the way they always have. And ultimately, even if traders are pushing prices up and down quickly, over the long term, you have to get back to the fundamental value of what things are worth. Because if the stock market's irrational for too long, you'll have a strategic buyer come in and buy that company out. So that's my belief that things haven't changed in that fundamental way.
Yet there's a record amount of money waiting to do that strategic buying. It's not happening.
Maybe. I mean, there's a lot of cash on the sidelines, a lot of private equity money and things like that. And I don't know if you were watching Warren Buffett speak earlier this week,
Said everything's too expensive.
but he says everything's too expensive. So, I mean, that's the reverse problem of maybe what we're talking about, right? As an investor, if you own a lot of assets, everything's too expensive, at least for now, means values are up. But for a buyer like Buffett, he's waiting for that next downturn. He just has to be patient. So.
He's an old guy.
He knows what he's doing, I think. Yeah, for sure. Any other questions? Sure.
So you mentioned the Fed and the markets at the end of last year, and then sort of their reversal, and the markets obviously springing back.
Yeah.
December, January.
Right.
Is there anything besides the Fed that you feel like accounted for December, January?
I think a lot of the trade optimism is a big part of it, and it's hard to know exactly why markets went down so far. I mean, I feel like 20%, almost 20% down is a complete overreaction. You really only see those 20% downturns if there's a recession, and clearly there's a lot of people talking about recession, but you saw the GDP numbers out this morning. They were up 2.6%. I mean, that's nowhere near zero. In order to have a recession, you need 2 quarters in a row of negative GDP growth. We were nowhere near that. So I'm not exactly sure what the market was trying to do last fall. It could have just been fear. It could be selling to get selling. It could have been tax loss harvesting. And we've bounced back, but we're not back to all-time highs either. So I would say, a lot of the bounce back we've seen this year is just a recovery from an overshoot before. But really, the Fed was huge. It's a big deal. It's a game changer in terms of how people see valuations, and it makes it easier to buy stocks. But I really think a lot of what we're seeing in the rally so far is hope that the trade war with China will get resolved. And I think ultimately that's one of the main things holding the market back right now.
Usually somebody asks for stock tips.
You haven't called me lately,
Yeah, I try not to just throw
How
tickers out
about
there.
sectors?
Sectors?
What sectors do you like?
Right now, I would say, even just asset classes. I mean, I still like the U.S. over international. I think given what mid caps and small caps have done year to date, they're now back to probably where they should be. So I think I like large cap versus mid cap and small cap going forward. But I think emerging markets are definitely worth a look. It's binary. It's going to depend on what happens with China at this point. But I think if you could put some money in emerging markets and put a lot of money in probably U.S. large caps, that's the best place to be right now. Once Europe figures out, or if Europe is able to figure out some of their problems, I think there'll be some good opportunities in Europe later, but I don't see them there now.
I think one of the discussions is when the market's going like it has been going, just talk a little bit about a case to hold bonds.
Sure. The way I look at bonds, at least as far as for most investors' portfolio, is that over the long run, you're most likely to get a higher return with stocks. And so the question is just what percentage of your account do you want to have in equities, because that's going to give you the largest return over time. But between the volatility of equities, which are difficult to sleep at night and difficult to live through, and the fact that if you're taking money out of your portfolio, that sequence of returns that we were talking about earlier, the fact that if you're trying to take out the same amount of money when stocks are high, that's fine, but when stocks are really low, you can't do that. So by definition, there's pretty much every investor around has to have some portion of their account not in equities. And so the portion of your account that's not in equities, it can either be in cash or it can be in bonds. And through almost every scenario, bonds will typically outperform cash. Now, last year they didn't. That's a great example of a counterexample to that. But for most years they will. And I don't believe the Barclays Ag has had 2 negative years in a row for as long as I can remember. So almost the safest bet on bonds outperforming cash would be the year after they hadn't, and that's where we are right now. So I think bonds make a ton of sense right now because of that, and you can't be 100% equity, so you have to have some type of bonds.
Did you say bonds are better because of the bad guys?
Bonds are better than cash. Not better than stocks, but better than cash. Yeah.
People hold more cash, or funds hold more cash than equity.
I mean, if your cash is short-term bonds, then you're okay, right? But if your cash is just sitting in Bank of America earning 0.25%, you can do a lot better with almost any other investment that's relatively safe. I mean, just look at treasuries, which are just as safe as your bank account.
A fair number of Stan's and Tom's clients are nonprofit organizations, and you've got the Community Foundation in here, and Council Prevention Fund, and other nonprofits. Any particular advice you would give to organizations that are more inherently conservative than most?
I mean, I think the most obvious is to take advantage of the taxable status. So the fact that you're not taxable gives you an advantage over your individual investor who isn't. But really, I would say it's more about your time horizon. If as a nonprofit or an endowment or looking at something that's got a longer time horizon, hopefully you can allocate more of your account towards equities than you normally would because you've got a longer time horizon. But if you are conservative, look at the type of equities you're putting in there. So more dividend-paying stocks, more stocks that are going to be less volatile, lower beta, I would say. So that's what I would do. Rather than saying I want to be out of stocks and I want to only be in bonds, I would push back and say be in more conservative stocks to the extent that you can and complement that with bonds rather than just purely doing that.
You mentioned you didn't see a recession in your earlier slide, but looking at that blue line,
Yeah.
what's your crystal ball saying to you?
My crystal ball? Well, again, I mean, it's impossible to know, but it feels like we may have a couple more years before you have a recession. And I know everyone's saying, yeah, we're definitely going to have a recession by the end of 2020, but I think those same people were saying we're going to have a recession by the end of 2010, and then they said we'd have one by the end of 2012, and I think they said we were going to have one at the end of 2015. So I think the easy thing to say is recession is 2 years away because at some point that will come true. But for everyone who's been convinced about that since 2009, it hasn't been true. So I'm going to take the other side and say I think it's going to be past 2020. But if we have problems with China or the black swan comes, then all bets are off. There's nothing you can do about that. We will have one. So.
He's trying to give you an honest answer. But I mean, if you look at the track record of consensus opinion on calling recessions, it's miserable. I mean, by economists, by the people that are supposed to know this stuff.
Right. Because it's very unpredictable. It's hard to know.
Well, the bigger tragedy is we still haven't recovered to the norms.
That's true. Well, that's our potential. That's our potential is to go higher.
Instead of talking about potential, the market talks more about when recession occurs. It's a given.
This,
Right.
well, they call this the most unpopular bull market ever.
Right.
For good reason.
Yeah.
Yeah.
Well, that's not the chart of stocks, though. Stocks have done really well. They've tripled, right, since the bottom.
Companies follow GDP, and stocks may be different behavior.
True.
Well, all the underlying track and the corporate performance is what.
Yep, that's right. I agree.
Sorry to lecture.
No, you're right. I agree with you. I agree with
Here, you want, take my mic.
you.
Other questions? We good? Well, again, thank y'all really for taking time to join us this afternoon. Don't forget that we've got food up here. There's also food being passed, but please take advantage of that. It's paid for. I think that if anybody's interested, there was talk about possibly you wanted to go take a look at the brewery. Somebody can show you through. We're here for a while, so don't rush off. But again, thanks very much for being. What is he saying? Oh. I think everybody, we've just, we're kind of venturing into the multimedia world, and we just did our first full podcast a couple of weeks ago, and I think everybody in here is on our list to receive notification of that. I don't know if he's still here or not. Michael Khalifi from Thomas Howell Ferguson was our guest, so you can pick up some tax tips. But we've tried to figure out, I know everybody's busy, and so I've personally started listening to more and more podcasts just because it's an easy thing to do while you're in the car. But hopefully y'all will find some of the information useful on that. If you're not receiving it, let us know. We'll make sure you get it. But again, thanks for being here. Have a great evening, and please help yourself to some great beer and food.